Let me now introduce and bring on board Vishal Khandelwal, founder of a very famous investment blog, SafalNiveshak's. Vishal, it's your first time on ET, so a very warm welcome.
Thank you.
I track your blog, I follow your Twitter handle. Must say I'm very impressed with the kind of work you're doing for retail investors. So congratulations on all the
Glad
good
to
work.
know that. Thank you so much.
You started in which year?
I started SafalNiveshak in 2011.
And how many subscribers do you have now?
I have around 35,000 readers so far.
Wow. So that's quite an achievement right now.
Not sure. I think it's a journey. It's a long journey.
But the idea is really to propagate long-term investing.
Yeah, the entire idea is to propagate long-term investing, and I think the core of my work at SafalNiveshak is to help people not lose their money.
Okay.
So I talk about the secrets of making money, but I think the most of the work, if I go back and see, is to help people how not to lose their hard-earned money.
How did you get inspired to do this? I mean, are you an investor?
No, I think
stock market.
Yeah. So I was an analyst for 8 years, and 2008 till 2008, if you were an analyst, you thought you were the master of the universe, right? So you thought everything you recommended was gold, right? Would make people money. But that 2008 period brought me a realization. I saw people around me. I saw people in my distant family losing a lot of money. So the idea that time was to go on ground, meet people, teach them the most important rules of investing sensibly.
So first you were a preacher, now you're a practitioner.
I am a practitioner too as well now.
Okay.
Yeah, so that combines the role currently.
Okay.
So how do you not lose money in this market? Because that's what you're worried about after the market almost hitting an all-time high, 10,200 almost, and then, now you're seeing this volatility kick in, some intermittent corrections, suddenly there's talk of North Korea, US, etc. And you're a little worried as to, whether this is a bubble which is waiting to burst or not. And you don't want to see a repeat of, I shouldn't say 2008, but you don't want to see those February kind of levels as well.
That's right. So when I say not losing money, I think I'm talking more from a perspective of not losing money permanently. Stock market volatility, and this is what I teach people, volatility is not really the risk, the real risk that you face. It's losing your money, losing your purchasing power permanently over long term. And you can do through several means, I think, buying stocks or buying businesses which are good, sensible, long-term wealth creators, right? Buying good quality managements and staying away from the stock market. So if you are not acting a lot in the stock market, if you are spending your time somewhere else, I think you can be a much more sensible investor than looking at the stock markets on a daily basis.
So these are 3 ground rules that have never failed you when you're reading a balance sheet.
So in terms of reading a balance sheet, I think one of the most important things which I look at is the leverage, the debt on the balance sheet. So I have been like safeguarded on that front. I've kept away from companies which borrow a lot of money. Second important thing which I look at when it comes to balance sheet is the working capital. So a lot of companies need working capital to run their operations, which is perfectly fine. But I just hate companies which require a lot of that, because it's like a treadmill. You keep running, you don't go anywhere, right? And the third thing which I like about reading balance sheet, if I were to draw an analogy, balance sheet is more like an engine of a car, right? And your profit and loss income statement is the dashboard, right? And the third statement, which is the cash flow, is the fuel. Right, so however fast you want to drive your car, it is limited by the power of the engine, right? So the power of the balance sheet really drives growth of a business over the long term. And companies which want to grow rapidly over the long term, if the balance sheet does not support that, right? If they don't have that fuel in the tank, which is the cash flow, I think it's very difficult.
So driver is the management and the competition is traffic?
Driver is the management, the competition is traffic, and the car is the company as a whole.
Okay.
Yeah,
so is there any such car which you think is going to stall, just looking at the cash flow, the balance sheet, all of it, where you think this is something that I need to stay away from?
No, there are a lot of businesses which look good in terms of growth, right? So people actually people in the stock market get enamored by growth, right? So they like companies growing at 30–40%. But if the company in pursuing that growth is not achieving a good return on capital, it's, as I mentioned, it's like a treadmill. It's like a dead business, right? You should try and stay away. Those are the businesses that lose you money permanently.
Right. So what are those businesses? Name it for us.
I don't want to put some names, but I think look at companies which spend a lot of money in terms of growing, in terms of capital intensity.
Sure.
So look at businesses which are, when I say look at, be very careful of businesses which are capital intensive. Be very careful of managements which have a shady background. So I think one checklist which I use is when I search for a new company, I use the name of the company on Google plus a word called scam or a fraud or allegation. So if you can find such companies who have a history of doing something wrong in such managements, it's better to stay away because people don't change.
Two quick questions, and you know, we'll one is on debt, right? So typically the ratio over there is debt to equity should be less than 1, which is seen as fairly well managed, right? Any debt to equity higher than 1 is a problem. For working capital, what's a good measure?
I think working capital, you need to look at the cash conversion cycle. So how fast is the company churning its cash, right? Getting back the cash. So
your debtor days, creditor days, all of that.
Yeah, so look at that thing. You'll find a lot of companies which are working on a negative working capital, which means they are getting paid faster and they have to pay their creditors after a lot of time. So even when it comes to debt equity, I am not really worried if a company has, say, a one-time debt equity. Yeah, but what is more important for me is to look at companies which also have the repaying capacity. Right, so if they have enough profits to repay the interest, right? So if they have enough cash flows to repay their debt over long term, that's what's important.
Okay, now let's talk about what you've analyzed recently, D-Mart,
that's right.
Avenue Supermart. I mean, this is like the cult stock in this bull market, that's right? So I'm going to go step by step, and this is your work which we are putting on air. I mean, with the disclosure that it is Vishal Khandelwal's or SafalNiveshak's work.
This and perfect timing, Nikunj, because today you're talking about Goldman Sachs report.
Just a coincidence, okay. Do you think the first point, which Buffett says, to be a better investment, you have to be a better investor and vice versa?
That's right.
Company belongs to Radhakrishnan Damani.
That's true.
Who has made his balance sheet by betting on other balance sheets.
That's true.
And now we are analyzing his company's balance sheet.
That's true.
What strikes out for you, the first thing?
I think, as I mentioned the thing, you need to be a better investor to become a better businessman. So that core of being a value investor as a promoter, I think that comes out very well in the annual report. The kind of simplicity which they have, I'm talking about the annual report.
Yeah, of course.
The kind of simplicity with which they have.
He's a simple man.
Yeah, he's a simple man, right? Yeah. He's used some kind of behavioral things that value investors talked about. In terms of, you go to one of the pages where they talked about the expansion, he's shown a map of India and D-Mart's presence 15 years back, then 10 years back, and now latest. So you see that slow contrast, a big contrast building up over a period of time. And they're talking about patience, they're talking about conviction in their work, right? So, and they're talking about building a balance sheet which is clean, they're talking about inventory management. So they are, I think if I look at their numbers, they have amongst the best inventory turnovers in the industry, which is good.
What I find funny about D-Mart balance sheet is that we all know that the company belongs to Radhakrishnan Damani, but where is he? I mean, I don't see him playing an operating role. He's the mentor who created business and he's created a company of $10 billion, but the essence of his presence is not there.
No, I think the essence of his presence is shown in the performance of the business and how they are managed. I think we have seen recent cases where promoters have interfered in the affairs of the businesses and they have actually hurt shareholders. So by being a mentor, by guiding the company on a broader scale, I think, and by not showing your face and not being there per se, right, appearing in front of people, I think that's a good strategy. Till the time the business does well, I think till the time your mentorship is helping the business going well, I think it makes a lot of sense for him to not really come and appear.
So you're sold on Avenue Supermart, looking at the quality of their balance sheet and their annual report as well for the next foreseeable future.
Yeah, I like the business per se. So they are among the best, among the better managed, let me say that way, retail companies. Value retailing is a buzzword. It's not really a buzzword which is recent. India is a country where people are looking for affordability, right? So I am a user of their business, right? So I consume a lot of stuff buying from their shops, and I can realize, I can relate that they are one of the better managed retailers. So this is as far as business is concerned. I'm not so sure about the valuation. So
yeah, so that was exactly my next question. You have the valuation ratios, which are a series of price to earnings, price to book, depending on the business cycle, EV per EBITDA, etc., etc. And then you have the return ratios, which is what you know, return on equity, return on capital employed, and return on assets. As an investor, how do you, where is the bias? How do you go around screening through all these numbers to find your investment rationale?
So I think the most important numbers, as I mentioned, are a clean balance sheet, which does not have a lot of debt on the balance sheet. And the company is having a good return on capital. So that return on capital is very important. If you look at a retail company or a D-Mart kind of a company, the return on capital will be around less than 20%, which is true of all retail. They are still a growing business, right? And retail is a business where the guy has to be smart every day. It's a smart everyday kind of a business, right? So you have to beat the competitor almost every day. You have to outthink him. So in that front, that's a risk which I think any company, including D-Mart, has. When I combine that with super high valuations, that's something that concerns me. There's a concept called margin of safety in investing, where people think that margin of safety is buying something worth 100 rupees for 50 rupees. You're buying something cheap. But a lot of times the business also provides you a margin of safety, right? So here in DMart's case, the business provides me a margin of safety in terms of good quality management, good quality business, but the valuation or the stock price does not have that margin of safety. So that is where I get stuck.
Before I move to the next stock, and we would be analyzing Info, just a coincidence that Sanjeev Bikhchandani was also there, not planned, but just a coincidence, one of those coincidences.
That's right.
My last question on D-Mart or Avenue Supermart is, if I look at an example like Subiksha, it had a great start. They were there in South, and when they started growing, that's the time balance sheet really got messy. They started borrowing a lot.
That's it.
And what was like a textbook study, Subiksha, ended up like a bankrupt franchise. Can the balance sheet of D-Mart support the kind of mega expansion what he's talking about?
I think that's one concern, but as I mentioned, the quality of the management would make a lot of sense here. So retail, as I said, is a be smart everyday kind of thing. So if you have sensible guys who are value investors, who bring that value investing ethos of having margin of safety in the way they grow their business, I think that is what should make a difference between the kind of growth that they want to pursue versus Subiksha.
By the way, the annual report has a comment from our good friend Ramesh Damani. He's the chairman of Avenue Supermart. So, okay, the next one is Info Edge.
Yeah.
Clean numbers.
Very clean.
1,000 crore plus is lying in the cash.
That's right.
And they're generating a lot of other income with that. I like the operating business, but I'm not sure what they're trying to achieve with the investee companies.
That's true.
So how would you rate the balance sheet?
So Info Edge has been one of my favorite annual reports for many years. No, I don't own the stock. I don't own the stock.
Let's have the disclosure.
I don't own any stocks, even Avenue I don't own. So it has one of my favorite annual reports for many years, simply for the kind of disclosures that they have, the forthrightness of the management shown in terms of disclosing the rights and wrongs of the business. They have shown that in their numbers as well when they sold off a lot of their loss-making investee companies in the past as well. So that's, as you mentioned, I think that's a pain point of having invested so much money in companies which are like new, growing, and we are not really sure about their future. So one of the business, which is Zomato, is starting to pick up, but again, sustainability is a big issue. And with so much money already sunk in such kind of businesses, so that's something which is a pain point for the consolidated business. If you look at the standalone business, the core business of recruitment, matrimonials and real estate, they're doing pretty well. They are in fact growing well over there, and they're managing their numbers.
They're
in
now
terms
making profits on Jeevan Sathi and 99 acres. Just
they are not.
In fact, from Sanjeev's interview, I gather that they have the option to make money on Jeevan Sathi, but they're choosing to reinvest.
That's I think that's fine till the time you are reinvesting and you're growing your business profitably. So if you look at their balance sheet, right, it's a negative working capital company. They don't have inventories; they have receivables, right, and their working capital, their receivables is actually funding not only their fixed assets. It's also funding their current liabilities. So you have a highly negative working capital business, free cash flow which is flowing in bounds, which they are utilizing
on a daily basis.
On a daily basis. So again, the one thing which I need to, or which any shareholder need to watch out here, is what they're doing with the investee companies. So that's the only concern that I have with.
But that is the option value, isn't it? I mean, that for me is the good part or the sexy part of the balance sheet.
That's true, but it can go anywhere.
Okay.
That's the question. When it comes to investing, even if you're a value investor, you're gambling on the future, right? But being a value investor, being sensible means you're trying to bring the odds in your favor. Here, the odds are 50-50.
Okay, so let's quickly get across to the third one, Symphony. How would you rate the balance sheet?
It's a beautiful story that they've talked about in their annual report. So it's a good business as well. I like the business in terms of their balance sheet, in terms of the cash flow, income statement. One thing which I did not like about Symphony's annual report is that the storytelling sometimes goes overconfident. So it shows the overconfidence of the management. They are actually bashing the competitors left, right and center, which I think may be a sign of times, maybe what they have done in the past few years. So that is something that worries me as far as the management and the annual report and the story that they have talked about. A story has a base, so it's not that they are like saying fluke. They have a base in terms of numbers, in terms of the balance sheet, in terms of the growth, in terms of the products as well. But I'll be watchful on the delivery of what they're promising, plus of course the valuation. So these are all businesses where the valuation is something that really pulls you back.
You've not, I mean, we've analyzed consumer-oriented kind of businesses, right? Either through the online portal or D-Mart. What about financials? Any balance sheets that you've read there?
Financials, first thing, I don't understand financials.
Okay.
Second thing, I don't trust them. Right, and third thing is, I think they are among the sectors which is trying to grow very fast. Right, so growing very fast has a risk. It has a valuation risk. It has an expectation risk. And a lot of people I meet, a lot of people I talk to, retail investors, they have a lot of money invested in financials because of the hot growth story. But most people don't understand the balance sheet of financial, like me.
You know,
right?
there are 6,500 listed companies approximately, plus minus 100 or 200.
That's right.
You've looked at 3 balance sheets.
That's right.
Any particular reason why out of 6,500 you've zeroed on these 3 balance
Not
sheets?
really. So 3 is.
How many balance sheets do you track or annual reports do you?
No, I try to read a company at least a couple of days. I try to read those kind of entire company, a few years of balance sheet for a couple of days. One company every 2 days. But as I mentioned, my universe is very small because I have very strict criteria.
So these are 3 balance sheets. You would say they're classic balance sheets.
They are good balance sheets, good businesses. So I don't think there are good or bad annual reports. Only they are good or bad businesses. Right, so if there's a bad business, the annual report, however good the story is, it'll be bad.
If my memory serves me right, Symphony was a BIFR case.
Yeah, that's true.
Which means they have messed up in the past.
They have messed up.
The capital allocation was all over the place. And I'm not so sure what they're trying to achieve right now also.
That's what I'm worried. That's what I'm worried about, the overconfidence of the story that they're trying to build. They have turned around beautifully in the last few years. But that overconfidence and combined with what they have done in past in terms of misallocating capital is what really is concerned.
Now let me ask Vishal Khandelwal, the investor.
Yeah.
Do you think margin of safety in these 3 stocks is missing?
In terms of business, it is there. In terms of valuation, it's missing, I think, for all of them.
All of them?
Yeah. So,
so a good business may not be a good investment?
Yes, always. Yeah, a good business is not always a good investment. Sometimes you can find average looking business. See, I think most wealth is created when the business looks uncomfortable, right? So when things are comfortable, the valuations are not good.
Good news, good price rarely comes together.
That's right, that's right. So analyzing businesses similarly as I think a detective solving cases, and one person where I look up to is Sherlock Holmes. So if I were to go and look at his case studies, right, there's a four simple steps that he follows. The first is knowledge, right, the knowledge that you bring on table from your past case history. The second is observation. Observation is when you're observing the details of the present case. The third is deduction, what you deduce from the knowledge and observation in the first 2 steps. And fourth is arriving at truth. And truth is also not certain, it's a probability which is close to certainty.
And your interpretation is better.
Yeah, that's right. That's very important. And reading annual reports, solving business analysis is a 4-step process. Reading annual reports is more of observation, but it feeds into the knowledge that you can bring on for future annual report studies. And I think one final lesson which I learned from Sherlock Holmes is you don't take things on face value. In the same way, when you read annual reports, don't take things on face value. Try to connect the dots. It's very important. So I think that's one lesson which I want to leave people.
I have just one last follow-up question, Raisha. I'm just tempted to have a follow-up question. I think on Sherlock Holmes, I don't read too much of fiction. Sure. So I'm not really the right guy to ask you. I mean, I've seen the 2 movies of Sherlock Holmes. That's about it.
That's true.
Which is one classic balance sheet you would say that, look, this is my all-time favorite balance sheet, because Symphony balance sheet 10 years ago was a bad balance sheet.
That's true.
Info Edge balance sheet wasn't there.
That's true.
And DMart has the first annual report which has come out. So which is this all-time favorite of yours?
And if I can just add to what Nikunj is saying, because that was running in my mind. The Satyam issue that happened so many years ago.
Oh my God.
That balance sheet got everybody misled for a really long
time. No, I mean
the
auditors
as well. So how do you catch that?
You cannot trust that. So there are a few parameters that you need to look at. So as I mentioned, I do a 5-minute test on a balance sheet to really look at it or junk it. So one is the debt to equity. One is if the revenue is growing or not growing. The third is the auditor's report. Of course, auditors don't have the incentive of saying wrong about the company like Satyam, right? But in case of Satyam, if you were to go back 2008 or 2008 when the scam really came out. But look at the previous 8 years shareholding pattern, and every year the promoter shareholding has been declining from around 25% to 8%, I think 2%. So if you're looking at that part, when the promoter is actually selling off shares, however good the business is, whatever is the auditor saying, I think you need to avoid that business.
Okay, so all-time favorite.
All-time favorite, I think good businesses, I would look at Titan and Asian Paints. They have been like well-managed classic businesses.
But Titan also, like 15 years, I mean, it had a high debt on its balance sheet.
That's perfectly fine. The way they have managed their income statement in terms of, so debt is one thing, ability to repay that debt is another important thing.
True.
Yeah.
But that doesn't always make you money.
Yeah, one of those fascinating topics. I can go on and on. I have so many follow-up questions, but we'll leave it for next time.
For sure. I look forward.
But it's such
Okay, but next time let's have you in the
chat.
investor avatar and not just reading balance sheets. We'd love to chat more about
My
that
pleasure.
as well.
Thank you so much.
Great speaking with you.
So
Thanks so much for joining in.